If you own property in Canada, particularly if you have reached retirement age or find yourself approaching that milestone, you have almost certainly encountered the alarming headlines and viral social media posts raising a troubling question. Are federal authorities preparing to impose taxation on the equity accumulated in your principal residence beginning in 2026? This question has generated considerable anxiety among Canadian homeowners over recent weeks. Speculation surrounding a potential new federal levy tied to residential property equity has spread rapidly through online platforms and community discussions. For millions of Canadians, especially those who have spent decades paying down their mortgages, the prospect of facing annual taxation on home value without actually selling the property represents a deeply unsettling possibility. After all, for countless retirees across the country, the family home constitutes far more than shelter. It represents their most significant financial asset, their primary safety net, and in many instances, their entire retirement strategy. This report provides a comprehensive, fact-based examination of what policymakers are actually discussing, what has not been formally proposed, what remains legally and constitutionally possible, and what Canadian property owners should realistically anticipate as the calendar advances toward 2026. When matters concern your most valuable asset, misinformation spreads rapidly. However, verified facts and careful analysis matter considerably more than speculation. The fundamental concern driving this discussion centers on potential federal taxation based on accumulated home equity. For those unfamiliar with the terminology, equity simply represents the difference between the current market value of your residence and any outstanding mortgage debt. If current market conditions value your property at $800,000 and your remaining mortgage balance stands at $100,000, you possess $700,000 in equity. For the majority of retired Canadians, this equity figure has expanded substantially over decades as property values appreciated and mortgage principal was systematically reduced. The anxiety gripping many homeowners stems from speculation that federal authorities might introduce some form of annual assessment based on this accumulated equity, regardless of whether the property owner has sold or transferred the residence. Such a policy would represent a fundamental transformation in how Canadian taxation authorities treat residential real estate. Understanding the current framework proves essential before reaching conclusions about potential changes. Under existing Canadian tax law, unrealized gains on principal residences remain exempt from taxation. This means that appreciation in your home's market value generates no tax liability unless and until you complete a sale transaction. Even upon selling, the principal residence exemption generally shields homeowners from capital gains taxation on accumulated profit. This exemption has functioned as a foundational element of Canadian housing and tax policy for generations. Federal authorities have indeed introduced several housing-related measures in recent years. These include the underused housing tax, which applies primarily to certain non-resident property owners and foreign nationals holding vacant or underutilized Canadian residential properties. Additionally, anti-flipping regulations now treat certain short-term property transactions as business income rather than capital gains, changing the tax treatment for quick resales. Various municipalities and provincial governments have separately implemented vacancy taxes or speculation levies targeting properties that owners leave unoccupied. However, these existing policies remain targeted and specific in their application. They do not constitute broad-based annual taxation on the equity held in primary residences owned and occupied by Canadian citizens or permanent residents. This distinction proves critically important for understanding the current policy landscape. The question naturally arises regarding the origins of these widespread concerns. Investigation suggests that much of this anxiety connects to broader ongoing discussions about housing affordability, wealth distribution, and government revenue challenges. Canada, similar to numerous developed nations, confronts escalating healthcare expenditures, demographic aging, infrastructure investment requirements, and climate-related spending pressures. Simultaneously, residential property values have surged dramatically over the past decade, particularly within major metropolitan centers, including Toronto, Vancouver, and surrounding communities. This economic reality has created circumstances where numerous long-term homeowners, particularly those in retirement, find themselves characterized as asset wealthy but income constrained. Their properties may carry market valuations far exceeding original purchase prices, yet their monthly income consists primarily of Canada Pension Plan benefits, old age security payments, guaranteed income supplement allocations, and perhaps modest private pension income or savings interest. From academic and policy perspectives, certain economists have debated whether housing wealth warrants different treatment within the taxation framework. Within scholarly circles, observers occasionally encounter discussions concerning wealth taxation mechanisms, land value assessment approaches, or potential reforms to capital gains regulations. However, academic discussion and legislative action represent fundamentally different categories. For federal authorities to implement annual taxation on home equity affecting principal residences, substantial legislative transformation would prove necessary. Such changes would require comprehensive parliamentary debate, detailed committee examination, development of regulatory frameworks, establishment of administrative systems within the Canada Revenue Agency, and coordination with provincial governments. This coordination requirement exists because property law falls primarily under provincial jurisdiction, according to constitutional arrangements. Constitutional questions would almost certainly arise from any such proposal. Property rights and civil matters constitute primarily provincial responsibilities under the Constitution Act. While federal authorities possess taxation powers, any sweeping change affecting residential property ownership nationwide would face rigorous legal examination and substantial political opposition. Political reality further complicates any such proposal. Home ownership rates across Canada remain elevated compared to many peer nations. A significant percentage of voters, particularly older Canadians who participate in elections at higher rates, own their homes outright or have accumulated substantial equity. Introducing direct annual taxation on that equity would represent perhaps the most politically sensitive policy decision any government could undertake. This assessment does not suggest that housing policy will remain static indefinitely. Governments possess authority to adjust tax regulations and frequently exercise that authority. The capital gains inclusion rate increased in 2024 for certain categories of gains exceeding specific thresholds. That modification generated considerable debate, particularly among investors and business proprietors. Nevertheless, the principal residence exemption itself remained intact. Ongoing policy conversations address mechanisms for increasing housing supply, addressing speculative investment activity, and improving affordability for younger Canadians facing barriers to home ownership. These discussions may eventually produce targeted measures, including stricter reporting requirements, modifications to short-term rental taxation, or adjustments to development incentive programs. These potential changes differ fundamentally from annual taxation on accumulated home equity. For retired Canadians following this issue, the practical question remains paramount. Should homeowners prepare for new federal tax obligations beginning in 2026 based solely on their property's accumulated value? At present, no enacted federal policy imposes such taxation on principal residences occupied by Canadian citizens or permanent residents. Nonetheless, maintaining awareness of policy developments remains prudent. Federal budgets typically receive presentation each spring, and significant taxation changes normally appear in those documents. Should policymakers contemplate changes of this magnitude, such proposals would appear in a federal budget or fall economic statement, accompanied by detailed explanatory documentation and implementation timelines. Understanding how property taxation currently functions provides important context. Property taxes in Canada operate primarily at the municipal level. Municipal authorities assess property values and apply mill rates to fund local services, including police services, fire protection, waste collection, and infrastructure maintenance. Provincial governments oversee the framework governing property assessment procedures. Federal authorities do not issue annual property tax assessments for primary residences. Several provinces maintain property tax deferral programs specifically designed for senior citizens. Under these arrangements, eligible seniors may defer property tax obligations until the property sells, with interest accumulating on deferred amounts. These programs recognize that seniors may possess limited monthly income despite owning valuable real estate assets. Should any future policy broadly affect homeowners, such measures would likely incorporate exemptions, income thresholds, or deferral mechanisms protecting lower income seniors. Canadian taxation policy historically attempts to balance revenue generation requirements with fairness considerations, particularly regarding vulnerable populations, including fixed income retirees. Examining how other jurisdictions treat housing wealth provides useful perspective. Certain European nations maintain annual wealth taxes incorporating real property. Others impose higher property taxation rates but lower income tax rates. The Canadian system has historically emphasized municipal property taxation and capital gains regulations rather than federal wealth taxation mechanisms. When phrases like authorities targeting your home circulate through social media, they generate powerful emotional responses. For countless seniors, the family residence represents decades of sacrifice, countless mortgage payments, ongoing maintenance investments, and irreplaceable family memories. Suggestions that government might access accumulated equity can feel deeply threatening. However, policy decisions rarely occur as suddenly or secretly as social media platforms sometimes suggest. Those concerned about financial security can pursue constructive steps that do not depend on reacting to unconfirmed proposals. Reviewing retirement income sources provides valuable clarity. Understanding monthly amounts from Canada Pension Plan, old age security, and guaranteed income supplement payments establishes a clear financial baseline. Considering whether old age security benefits might face clawback provisions if income rises significantly helps with planning. Monitoring federal and provincial budget announcements keeps homeowners informed of actual policy changes. Those considering downsizing, refinancing, or utilizing reverse mortgage products should consult licensed financial advisors or qualified mortgage professionals. Decisions regarding accessing home equity should reflect personal cash flow requirements and documented financial circumstances rather than anxiety about hypothetical future taxation. Canadians holding strong opinions about housing policy may engage directly with elected representatives. Members of Parliament and members of Provincial Parliament conduct town hall meetings, accept correspondence, and respond to constituent concerns. Public feedback demonstrably influences political priorities and policy development. As 2026 approaches, larger issues shaping housing policy will likely center on affordability challenges, supply constraints, and intergenerational fairness concerns. Younger Canadians face substantial barriers entering housing markets in many communities. Policymakers experience pressure to address these concerns. That pressure may produce reforms, but reforms take various forms, and not all potential changes target existing homeowners or their accumulated equity. Governments must also consider broader economic stability when contemplating housing-related policy changes. Residential real estate represents a significant portion of Canadian gross domestic product and household net worth. Sudden or aggressive taxation changes that destabilize housing markets could produce cascading effects on financial institutions, pension funds, and the broader national economy. Federal policymakers remain acutely aware of these interconnected risks. During periods of uncertainty, distinguishing genuine policy signals from speculative noise becomes essential. Authentic signals emerge from official government documents, budget tables, tabled legislative bills, and attributed statements from named government officials. Noise originates from speculation, anonymous sources, and sensational headlines lacking verifiable references or official documentation. When encountering claims about proposed new taxes, asking straightforward verification questions proves helpful. Does a specific bill number exist? Has Parliament received formal tabling? Has the Department of Finance released background documentation? Has the Canada Revenue Agency issued implementation guidance? If answers to these questions remain negative, the purported proposal likely represents discussion, rumor, or opinion rather than enacted legislation. For seniors specifically, financial security frequently depends on predictability and stability. Canada Pension Plan and old age security benefits receive indexation to inflation rates. Guaranteed income supplement amounts undergo income testing annually. Property taxes receive assessment with advance notice. Major taxation changes typically include transition periods and clearly communicated implementation schedules, allowing affected parties time to prepare. The Canadian taxation system exhibits considerable complexity, but it also demonstrates substantial transparency. Budget measures receive public release with detailed documentation. Parliamentary debates appear in official records. Court challenges regarding taxation matters receive media coverage. Should a comprehensive equity taxation proposal emerge, implementation would not proceed quietly without public awareness and debate. This reality does not suggest ignoring housing policy discussions entirely. It does suggest that reacting to fear before facts receive confirmation can generate unnecessary stress and potentially motivate poor financial decisions with lasting consequences. At the core of current concerns lies broader anxiety about uncertain futures. Will retirement savings prove sufficient? Will healthcare costs continue rising? Will younger generations achieve home ownership? These represent legitimate questions deserving thoughtful public debate and careful policy consideration. However, framing suggesting imminent confiscation of home equity implies urgency and inevitability that current legislation does not support. Responsible financial planning involves monitoring credible official sources, consulting qualified professionals, and making decisions based on confirmed information rather than social media speculation. Looking ahead to 2026, the most prudent approach combines appropriate vigilance with measured calm. Monitoring federal budget announcements provides advance notice of genuine policy changes. Watching for official Department of Finance communications reveals actual government intentions. Understanding personal financial circumstances enables informed response to future developments. Evaluating any actual proposals in proper context prevents overreaction. Canadian homeowners have successfully navigated numerous policy changes over decades, from interest rate fluctuations to taxation reforms to housing market cycles. The system evolves continuously, but evolution proceeds through established processes involving public consultation, parliamentary debate, and legal review. Your residence remains your property under law. The principal residence exemption remains operative. Municipal property tax frameworks continue functioning as the primary mechanism for annual property-related taxation. Any significant federal changes would require time, debate, legislative process, and public examination before implementation. During uncertain times, measured analysis consistently proves more valuable than alarm. Should credible proposals emerge that might affect home equity, careful examination will reveal who faces potential impact and what response options exist. Until such proposals materialize through official channels, focusing on verified information and sound financial planning serves homeowners better than anxiety about speculation. The conversation about housing in Canada continues evolving, reflecting economic pressures, demographic transformation, and differing perspectives about fairness across generations. However, actual policy emerges from legislation, not viral headlines or anonymous social media posts. Senior homeowners benefit most from understanding how existing benefits, taxes, and property obligations actually function today. That knowledge provides the strongest foundation against fear-driven narratives and enables informed response to genuine policy developments. Monitoring of official developments continues, with commitment to providing clear, factual updates as circumstances warrant. At present, no enacted 2026 federal equity tax targeting principal residences exists in Canadian law. Discussion exists, debate continues, concern circulates, but legislation does not. When matters concern something as consequential as your home, verified facts consistently matter more than speculation and fear.